It feels like the market has this serious attention span problem right now.
Oh, absolutely. It's incredibly short-sighted.
Right. I mean, especially when you look at Devon Energy. We are looking at a company that is quietly running this massive, highly autonomous cash flow generating machine.
Literal cash printer at this point.
Exactly. And yet Wall Street is just punishing the stock. They're obsessing over, lease acquisition headlines and all these merger rumors.
Yeah, and that disconnect between the headline noise, dragging the stock down, and, well, the actual fundamental mechanics operating under the hood, that's exactly where the most compelling setups exist for you as an investor.
Which is why we are targeting Devon Energy, ticker symbol DVN, for today's Talk Tickers Deep Dive.
It's the perfect case study right now.
It really is. So if you only look at the ticker price, you'd assume there is some massive operational problem.
Right, you'd think the sky is falling.
But when you actually bypass that market sentiment and look at the mechanics of the business following the Cotera merger, the underlying engine is running at a level of efficiency that, frankly, the exploration and production sector rarely ever sees.
It's practically unheard of for a company this size.
So the mission for this deep dive is to strip away all that Wall Street fluff, all that institutional impatience. We are analyzing their Q2 2026 earnings call.
And keep in mind, this call took place just 94 days after their massive corporate merger with Cotera closed.
Just 94 days. That is nothing in corporate time.
It's a blink of an eye.
So we're going to examine the headline numbers, break down the actual operational story driving those numbers, look at management's future guidance, and give you an actionable bottom line on what this means if you're holding or considering a position in this stock.
And that 94-day window, that's actually a really critical piece of context here.
How so?
Well, typically in the first full quarter following a multi-billion-dollar mega merger, the earnings call is just, it's an exercise in expectation management.
Right. It's usually the executive saying, please bear with us, we're figuring things out.
Exactly. You hear them asking for patience while they untangle these massive overlapping IT systems, deal with culture clashes in the field, figure out their newly combined supply chain. The standard playbook is to basically warn the market that capital efficiency will take a temporary hit.
But the Q2 data shows the exact opposite of that.
It really does. It defies the typical merger hangover.
Let's start with the production volume, since that's, the baseline metric for any exploration and production company. Devon's oil production hit 503,000 barrels per day.
Which is huge.
Yeah, that came in 1.6% above the midpoint of their own guidance. And if you look at total production, which factors in all the natural gas and natural gas liquids, they reached 1.36 million barrels of oil equivalent per day.
Pushing them right to the absolute top end of their guidance range.
Right, and usually hitting the top end of a production range like that, it requires a pretty brute force approach, doesn't it?
Oh, almost always. In these historically fragmented basins, if a company wants to beat their volume targets, they just spin up extra rigs. They pay these premium spot market rates for pressure pumping crews.
Just throwing money at the problem.
Literally. They fundamentally blow out their capital budget just to drag those extra barrels out of the ground. It's volume at the direct expense of margin.
But that is where the Q2 numbers completely deviate from the historical industry norm.
Yeah, this is the really impressive part.
Devon pumped that 1.36 million barrels, while their capital expenditures actually came in 2% below guidance. They landed at $1.3 billion for the quarter.
And that combination right there, that is the holy grail for a producer.
More oil for less money.
Exactly. They are pulling more product out of the subsurface while simultaneously shrinking the capital required to do it.
Hey.
And that capital efficiency filtered directly down into their unit costs.
Let's talk about those unit costs, because the total operating costs dropped to $8.23 per barrel of oil equivalent.
Which, just to clarify, includes lease operating expenses, gathering, processing, transportation, everything.
All of it. And that $8.23 is a 2% improvement over the midpoint of their target.
It's incredibly lean.
But I want to push back on that $8.23 figure for a second.
Okay, let's hear it.
We are in a macroeconomic environment where labor, steel, chemical costs, they've all seen this sustained inflationary pressure over the last few years.
For sure, inflation has been a massive headwind.
So driving total operating costs down to the low $8 range seems almost counterintuitive. I mean, how much of that is actual sustainable operational efficiency versus them just, getting lucky with some temporary dips in regional service costs.
It's a fair question. But if you look at the breakdown of their supply chain management, it strongly suggests this is systemic, not cyclical.
Meaning they built a better system, they didn't just get a temporary discount.
Exactly. That $8.23 figure is largely driven by their newly expanded scale in the Delaware Basin. When you consolidate your acreage position that much, you fundamentally change how you negotiate with the oilfield service companies.
Because you're the biggest customer in the room now.
Right. You are no longer bidding for a single frac crew for 3 weeks. You're offering these service companies a continuous year-round program.
Oh, like a guaranteed contract.
Exactly. That scale allows you to lock in much lower dedicated rates for sand, water handling, pumping services. It basically insulates the company from those short-term inflation spikes you mentioned.
It's like switching from buying groceries at a convenience store to buying in massive bulk at Costco. The unit economics totally change.
That is a perfect analogy.
Yeah?
And that cost control directly fuels the metric that actually matters most to an investor.
Adjusted free cash flow.
Yes. This quarter, Devon generated $1.7 billion in pure free cash flow.
Wow. $1.7 billion.
And that is capital left over after all operating expenses, taxes, and capital expenditures have been fully paid.
That is just massive. And to put that $1.7 billion in perspective for you, it is driven heavily by a metric the management team really emphasized on the call, their reinvestment rate.
This is maybe the most important number from the entire report.
In Q2, Devon's reinvestment rate dropped to just 43% of cash flow. Let's unpack the mechanics of that for anyone who isn't, analyzing exploration and production balance sheets every day.
Sure, yeah. Let's break it down.
This is essentially the percentage of operating cash flow that a company has to immediately plow back into the ground, drilling new wells, just to maintain their current level of production.
Because shale wells naturally decline over time. The oil stops flowing as fast.
Exactly. It's like a treadmill. And if you look back at the shale boom from, say, 2010 to roughly 2019, the industry standard reinvestment rate was routinely 80%, 90%.
Sometimes over 100%.
Right. Companies were generating revenue, sure, but because their legacy drilling techniques were so highly capital intensive and the well decline rates were incredibly steep, they were trapped on that treadmill.
They had to spend every single dollar they made just to keep their total production volume flat.
Exactly. They were literally destroying capital just to maintain the illusion of growth for Wall Street.
And that's why a reinvestment rate of 43% fundamentally changes the investment thesis here.
It means Devon only requires 43 cents of every operating dollar to maintain and even slightly grow their production profile.
Which leaves the remaining 57 cents of every dollar entirely discretionary.
That is so much cash. They can use it for dividends, share buybacks, or debt reduction.
Right. It's a massive paradigm shift from that capital destruction era of the past decade. It's the defining characteristic of a mature, disciplined operator.
But it immediately raises the underlying question, how are they mechanically achieving a 43% reinvestment rate while they are actively integrating a massive merger? You'd think the chaos of the merger would drive costs up.
You would think so. But that brings us to the operational reality on the ground. Management noted they already have over 350 specific synergy initiatives actively underway stemming from the Cotera integration.
350 initiatives in 94 days.
Yeah, they're moving fast. They are targeting $1 billion in annual synergies by the end of 2027.
That speed of integration is generating those synergies way faster than the market modeled.
Absolutely. Management stated that on day one of the merger, 95% of their core IT systems and processes were already mapped out and decided.
Day one. That's incredible planning.
By week 6, the entire organizational structure for office-based employees was totally finalized. And because they eliminated that corporate friction so immediately, they were able to centralize their drilling and completion teams without losing a step in the field.
So let's look at the actual output of those centralized teams in the Delaware Basin, because that is their premier asset. Yeah. Their well costs in the Delaware have dropped to $800 per lateral foot.
$800 per foot is just an aggressively lean number.
Just to visualize this, in unconventional shale drilling, you drill vertically down for a mile or two, and then turn the drill bit 90 degrees and drill horizontally through the target rock layer. That horizontal section is the lateral.
Right. And the cost to drill and case that specific horizontal section pretty much dictates your baseline profitability.
So hitting $800 per foot means they are just highly optimizing their drilling days.
They're reducing the time rig spend on site and highly engineering their completion designs.
What really stands out to me about that, though, is that management specifically noted this $800 metric reflects a trailing cost structure.
Yes, that is a crucial distinction.
Meaning the wells coming online in Q2 were actually contracted and drilled based on the supply chain realities from 6 to 9 months ago.
Right, before the merger synergies were even fully integrated.
Exactly. So the implication there is that the leading edge costs for wells they are spudding right now today could be significantly lower than $800 a foot.
That trailing versus leading edge dynamic is critical for investors to understand. As they continue to flex this integrated supply chain, combining legacy Devon and legacy Cotera logistics, the capital required to bring a new well online will likely just continue to shrink.
It's compounding efficiency.
Exactly. But the organizational scale, that's really only half the equation here.
Right. The real secret sauce driving that 43% reinvestment rate and the $1.7 billion in free cash flow is their deployment of proprietary technology.
This is where the earnings call reads more like a Silicon Valley software update than a traditional oil and gas briefing.
Yeah, let's dissect their use of artificial intelligence, specifically the closed-loop AI system they are currently running in the field.
So this closed-loop system fundamentally alters how a producing well is managed. Historically, an engineer would have to monitor the telemetry from a well pad manually.
Right, staring at screens.
Exactly. If the production started to choke or the pressure dropped, the engineer would manually calculate the necessary adjustments, physically drive out to the site, or remotely trigger changes to the gas lift systems or the wellhead chokes.
Which introduces massive latency. I mean, an engineer might only review the data for a specific well once a day.
Or maybe just once a week if they are managing a massive portfolio of legacy wells. And human intervention is inherently reactive. You're fixing a problem after it already started costing you money.
Right. So what Devon has deployed is an AI-enabled model that monitors the constantly shifting multi-phase flow conditions of a well in real time, 24 hours a day, 7 days a week.
It autonomously adjusts the mechanical levers on the wellhead without any human intervention at all.
So if the fluid density in the wellbore increases, the AI instantly commands the gas lift system to inject more gas.
Right, which lightens the fluid column and optimizes the flow rate to the surface immediately.
They refer to this on the call as keeping the well on the efficient frontier.
I love that phrase. It constantly calculates the absolute optimal balance between the energy required to lift the oil and the volume of oil being produced.
And the scale of this deployment is what makes it material to the bottom line, right? Because a few quarters ago, this was just a pilot program on a handful of wells.
Yeah, an experiment. By March, they'd expanded it to a couple hundred. But as of this Q2 call, they have this AI autonomously operating 1,000 wells simultaneously.
1,000 wells. And they noted they have an inventory of over 2,000 additional wells in the Permian Basin alone, just waiting to be integrated into this mainframe.
It's basically a massive upgrade patch for their old assets. They take a legacy well, connected to the proprietary AI model, and the well immediately begins producing more efficiently simply by eliminating the human latency and pressure management.
That is wild. And beyond the production phase, they're also leveraging a totally separate proprietary AI model in the subsurface planning phase.
Right, before they even move a rig to the site. This model ingests massive basin-wide data sets to predict well performance.
How does that actually change the capital allocation, though?
Well, in shale drilling, the biggest risk to your capital is spacing your wells too closely together.
Ah, right.
If you drill parent and child wells too close, the hydraulic fractures actually communicate with each other beneath the surface.
They steal pressure from one another.
Exactly, which permanently degrades the total recovery of both wells. It is a massive destruction of capital.
Frac interference.
Right, frac hits. So Devon's subsurface AI analyzes the complex geological data across their entire acreage position, modeling all these different spacing scenarios and completion designs.
So it allows them to highly optimize the distance between well bores based on the specific rock mechanics of that exact landing zone.
Yes. Management noted that the AI constantly hunts for gaps in expected performance versus actual performance.
And when the algorithm flags a discrepancy,
the engineering team zeroes in on it immediately to adjust their completion parameters for the next well.
Okay, so they are utilizing silicon to optimize the mechanics, but they are also utilizing advanced chemistry to physically alter the subsurface environment.
This is fascinating stuff.
Yeah, let's examine the surfactant testing they detailed, because the uplift in production volume here is a major catalyst.
To understand why a surfactant matters, you have to understand the fundamental problem with shale rock. Unconventional oil is trapped in microscopic pores within highly dense rock.
It's basically trapped in solid stone.
Right. So when a company hydraulically fractures a well, they're creating a network of tiny cracks to let that oil escape. But oil is viscous. It's sticky.
It naturally wants to cling to the surface of the rock due to capillary pressure.
Exactly. So even after you shatter the rock with millions of pounds of sand and water, a massive percentage of the oil just refuses to flow into the wellbore. It just stays down there.
That is the defining limitation of the entire industry.
It is. So during the completion phase, while they're actively pumping fluid down the well to create those fractures, Devon has begun introducing these proprietary surfactant chemistries into the mix.
A surfactant basically lowers the surface tension between the oil and the rock.
Right.
It is functionally a highly engineered solvent that washes the oil off the shale, allowing it to move freely through the microfractures.
It's like using dish soap on a greasy pan instead of just cold water.
That makes perfect sense. And the empirical data they presented on this call regarding this is just striking.
Yeah, they didn't just guess that it worked. To prove the efficacy of this chemistry, Devon utilized what are called offset control wells.
Meaning they drilled two identical wells right next to each other in the exact same geological landing zone.
Right. And they complete one using their standard water and sand mix, and they complete the other using the new surfactant chemistry. Everything else is a strictly controlled variable.
So that methodology completely removes the geological guesswork.
Exactly. And across trials spanning 6 different landing zones, they saw a material uplift in recovery on 90% of the wells tested with surfactant.
90%.
Yeah, and specifically at the 180-day production mark, the wells treated with the advanced chemistry were producing north of 15% more oil than the control wells.
A 15% increase in total volume for the exact same upfront drilling cost. The capital efficiency of that is staggering. I mean, if you're already paying for the rig, the steel casing, and the pressure pumping crew,
the marginal cost to add the chemical surfactant is incredibly small compared to the revenue generated by 15% more oil.
Which is exactly why management explicitly stated they are rapidly scaling this program. They are expanding the surfactant deployment to over 50 wells this year.
The executive team even noted they are internally pushing their operational leaders to stop treating this as a specialized test and just start adopting it as the baseline standard for every new well.
Wow. So when you aggregate these variables, the organizational speed of the Cotera integration, the autonomous closed-loop AI managing 1,000 wells, the subsurface algorithms optimizing well spacing, and this surfactant chemistry physically liberating more oil, the mechanics behind that $1.7 billion in free cash flow become very clear.
It is definitely not an accounting trick. It is a compounded operational advantage.
However, a highly efficient operational engine requires a steady supply of premium inventory to chew through, right?
Oh, absolutely. If a company runs out of top-tier acreage, all the AI and chemistry in the world cannot save them from declining returns.
Which transitions us directly to the most controversial topic from the earnings call. And this is a major reason the stock has faced recent headwinds.
The federal lease sale.
Right. 13 days after closing the Cotera merger, Devon participated in a federal lease sale in New Mexico, acquiring 400 new drilling locations in the Delaware Basin.
And the market reaction to this acquisition was largely negative, to put it mildly.
Yeah, primarily driven by the headline acquisition cost. The newswires reported that Devon paid $6.5 million per drilling location.
Which is a very big number.
I have to put my skeptic hat on here, because $6.5 million just for the right to drill a single well sounds exorbitant, even for Tier 1 Delaware rock.
It does sound like a lot on the surface.
When a company fresh off a mega merger immediately goes out and signs a massive check at an auction, the immediate assumption is that management is empire building. Are they just trying to justify their expanded post-merger balance sheet by wildly overpaying for acreage?
CEO Clay Gaspar addressed that exact skepticism head-on during the call. He bluntly admitted that their communication strategy surrounding this lease sale was flawed.
They fumbled the PR.
Basically, yeah. They announced the acquisition while still deep in the weeds of the merger closing, and they completely failed to properly articulate the underlying financial mechanics of the acreage.
Meaning the $6.5 million headline figure lacks crucial context?
Yes, specifically the context of the royalty structure.
Let's break that royalty math down, because management was adamant that the effective cost was actually significantly lower.
Okay, so whenever an exploration company drills a well, They obviously do not keep 100% of the revenue. They must pay a royalty to the entity that owns the mineral rights. If you are drilling on private land in Texas or New Mexico, the standard private royalty burden is typically around 25%, meaning for every barrel of oil you sell, 25% of the gross revenue goes straight to the landowner before you even begin to pay down your drilling costs.
But this acquisition was on federal land governed by the Bureau of Land Management.
Exactly. And these specific federal leases carry a statutory royalty rate of only 12.5%.
So the royalty burden is literally sliced in half compared to a standard private lease.
Exactly. Because Devon only has to forfeit 12.5% of the revenue instead of 25%, they retain significantly more cash flow from every single barrel produced over the 20 to 30-year lifespan of these wells.
That adds up.
It adds up massively. Gaspar detailed that when you run a net present value calculation on that retained revenue, the 12.5% royalty advantage translates to roughly $2.5 million in fundamental savings per location.
So the argument is you take the $6.5 million upfront sticker price, subtract the $2.5 million in lifetime royalty savings, and your true effective acquisition cost is functionally $4 million per location.
And in the current market for premium Delaware Basin acreage, $4 million per location is highly competitive.
Some might even call it a bargain.
Right.
I understand the net present value math, I really do, but I want to challenge the certainty of that $4 million effective cost for a second.
Okay, what's your hesitation?
Well, that $2.5 million in projected royalty savings is entirely dependent on commodity prices over the next 2 decades, isn't it?
Yes, it is tied to the price of oil.
So if oil drops to $50 a barrel and stays there, the gross revenue of the well plummets, meaning the absolute dollar value of that 12.5% royalty advantage shrinks significantly.
That's true.
Doesn't that mean they're taking on massive commodity price risk to justify the upfront premium?
That is a critical pushback. But it ignores the break-even mechanics of this specific acreage. This is not marginal rock that requires $80 oil to be profitable.
It's the core of the core.
Right. It is the absolute core of the Delaware Basin. Management noted that the break-even price for these specific locations is among the lowest in their entire global portfolio.
So even in a severely depressed commodity environment, these wells will still generate free cash flow, ensuring the royalty advantage remains highly accretive over time.
Exactly. And there's also the matter of how the auction itself functioned. Gaspar emphasized that this was an ascending auction bid, comparing it to a live eBay auction.
And that auction format provides crucial market validation, doesn't it?
It really does. This was not a negotiated private transaction where a seller anchor prices an asset and forces the buyer to meet it. This is a transparent live bid environment against their direct competitors.
Meaning Devon did not arbitrarily bid $6.5 million.
No, they bid exactly $1 more than the second highest bidder in the room. The open market dictated the clearing price.
Wow. And the quality of the acreage itself provides a massive operational advantage compared to buying land on the private market, right? Gaspar drew a pretty sharp contrast between this federal land and the acreage typically sold by private equity firms.
Oh yeah. When a private equity firm develops a block of acreage with the intent to sell it, their mandate is to juice the short-term valuation.
So they cherry pick.
Exactly. They will routinely cherry pick the absolute best drilling locations on the pad, drill them immediately to artificially inflate the production metrics, and then sell the company.
Leaving the acquiring company with the second-tier, highly degraded inventory, the meat is already off the bone.
But this federal acreage is what Gaspar described as grass to granite. It's completely pristine and untouched. No one has drilled a single well on it.
So this allows Devon's engineering teams to design the ultimate optimized development program entirely from scratch.
Right. They can utilize their subsurface AI to dictate the perfect well spacing without having to maneuver around any existing legacy wells.
They can plan massive, extended-reach lateral wells, maybe some up to 3 or 4 miles long, and tie them directly into Devon's existing gathering infrastructure, driving the capital intensity even lower.
Furthermore, Gaspar pointed out that due to regulatory shifts, this is likely the last federal lease sale of this magnitude and quality that will ever occur in the Delaware Basin.
It was a unique, finite window to grab generational acreage, and they secured it.
Right. So when you synthesize the operational data, the falling unit costs, the AI optimization, and the integration of pristine, low royalty acreage, you have a company engineered to throw off massive amounts of cash.
Which perfectly transitions us to section 3 of their strategy, which is management guidance and capital allocation. The central theme from the CFO, Shane Young, is an aggressive, multi-tiered approach to shareholder returns, balanced against a highly defensive balance sheet strategy.
Let's look at the dividend payout first.
Yeah, Devon increased their quarterly dividend by 33%, declaring a payout of 32 cents per share.
That resulted in $366 million being returned directly to shareholders in the second quarter alone.
And Young specifically noted that this 22-cent level aligns perfectly with their internal framework of targeting 10 to 15% of discretionary cash flow for the dividend.
By keeping the dividend anchored to that 10 to 15% discretionary band, they are ensuring the payout is structurally sustainable.
Even if commodity prices experience a significant downward correction, it is a baseline yield that won't require them to borrow money to fund it during a downturn.
But the dividend is really just the baseline. The aggressive return of capital is happening through the share repurchase program.
Yes. Prior to the Cotera merger closing, Devon was in a mandated quiet period and was legally restricted from repurchasing shares.
But the moment that quiet period expired upon the deal's closing, management immediately activated their expanded $8 billion buyback authorization.
$8 billion represents a massive percentage of their outstanding float.
And their execution speed really demonstrates their conviction here. In just the final 7 weeks of the second quarter, they retired 4.3 million shares.
7 weeks? That is aggressive.
And on the earnings call, management explicitly confirmed they have remained highly active in the open market throughout the third quarter. They are utilizing a hybrid approach.
Meaning they're executing systematic, algorithmic buying programs, but also reserving cash for opportunistic block repurchases whenever the stock experiences a disproportionate dip.
Exactly. But the share repurchases and the dividends are occurring simultaneously with a rapid deleveraging of the balance sheet.
Right. Let's break down this fortress balance sheet concept they discussed. A lot of companies talk about debt reduction, but Devon is moving at a highly accelerated pace.
They are structurally prioritizing debt retirement to bulletproof the company against the inevitable volatility of the energy cycle. During Q2, they paid down $250 million in senior notes and retired $250 million of a legacy term loan.
And then, subsequent to the quarter ending, they retired the remaining $750 million of that term loan in July.
Which means they completely achieved their stated 2026 debt reduction target of $1.25 billion.
They hit a 12-month goal in roughly 8 weeks. That is incredible discipline.
And their long-term guidance is equally aggressive. They are targeting a total absolute debt level of $9 billion by the end of 2027.
And if they execute on that target, Devon will maintain a leverage ratio at or below 1x EBITDAX through the entirety of the commodity price cycle.
A leverage ratio below 1x means their annual operating earnings completely eclipse their total debt obligations.
It basically removes existential credit risk from the equation.
Completely. Even if oil plummets to $40 a barrel, a balance sheet with less than 1x leverage allows the company to comfortably service its debt, maintain the base dividend, and opportunistically buy back their own stock at distressed valuations while their over-leveraged peers are forced into bankruptcy.
It transforms the balance sheet from just a liability management tool into an actual offensive weapon during a macro downturn.
It's a huge competitive advantage.
Okay, I agree that the debt reduction is impressive, but reviewing the forward-looking guidance for Q3, there is a specific metric that stands out to me as a potential red flag regarding their capital discipline.
You're talking about the Q3 capital expenditure guidance.
Yes, exactly. We have spent this whole deep dive analyzing their incredible capital efficiency. Driving well costs down to $800 a foot, hitting 350 synergy initiatives, dropping the reinvestment rate to 43%.
Right, the engine is humming.
Yet their official guidance states that total capital spending in Q3 is going to spike dramatically, jumping to between $1.4 and $1.5 billion.
Yeah.
That represents the highest quarterly capital outlay of the entire fiscal year.
It does jump off the page.
Right. If the operational engine is running so efficiently, why is the capital requirement suddenly inflating by hundreds of millions of dollars?
Yep.
It looks like the credit card bill is going up.
It is a totally valid concern on the surface, but when you actually look at the accounting mechanics, the Q3 CapEx spike is a calendar illusion rather than a breakdown in operational discipline.
A calendar illusion. Walk me through that.
You have to remember the exact timeline of the Cotera merger. The deal officially closed on May 7th.
Okay, meaning the Q2 financial results only reflect the combined unified company for roughly half of the 90-day quarter.
Exactly. The first half of Q2 only accounted for legacy Devon's capital spend. Q3 represents the very first full 90-day quarter where the combined run rate of both legacy Devon and legacy Cotera's drilling schedules are entirely consolidated on the balance sheet.
Oh, I see. It is simply a function of accounting for more operational days.
Correct. The daily burn rate isn't necessarily increasing. They're just legally required to report a full 90 days of combined spending.
So they aren't getting less efficient. They're just literally operating a larger company for a longer recorded period.
Yes. Additionally, the CFO noted that there were some normal logistical delays in Q2, like minor supply chain timing shifts regarding casing deliveries and surface facilities that pushed specific capital outlays from late June into early July.
That capital didn't evaporate. It just shifted across the quarterly accounting boundary into Q3.
Exactly. And crucially, that increased capital outlay in Q3 corresponds with a massive projected surge in production.
Right. Management is guiding for Q3 oil volumes to step up from 503,000 barrels per day to a range of 550,000 to 560,000 barrels per day.
They are deploying the capital, and the engineered production is immediately following.
Furthermore, the CFO provided forward guidance indicating that capital spending will naturally trend back down in the fourth quarter as they strategically reduce completion activity in non-core areas like the Marcellus and the Anadarko basins heading into the winter months.
Which perfectly transitions us to the final and arguably most consequential forward-looking catalyst discussed on the call.
The portfolio review?
Yes. During the Q&A session, almost every single Wall Street analyst attempted to extract details regarding this upcoming portfolio review.
Because when an exploration and production company executes a transformative merger that significantly increases their scale, standard operating procedure mandates a ruthless review of the legacy asset base.
You must evaluate every producing basin and determine what still fits the new corporate strategy and what should be divested.
Clay Gaspar was incredibly blunt regarding this process. He stated directly, every asset has to earn its place in the portfolio.
And he also acknowledged that because they publicly announced this strategic review, the executive team is currently fielding a massive volume of inbound inquiries from potential buyers.
Because the broader macroeconomic environment is currently highly favorable for asset sales.
Very favorable. Private equity firms, smaller independent operators, international joint ventures, they're all desperate for producing assets, making it a distinct seller's market right now.
So Devon is in a position to demand a real premium for their non-core acreage.
Exactly. Now, the analysts repeatedly pressured Gaspar to name specific basins or provide a hard timeline for divestitures.
But he completely stonewalled them. He called it the rumor du jour, refusing to negotiate in public.
However, he did clearly outline the rigorous framework the executive team is using to evaluate the portfolio. They are judging every asset based on 3 unyielding criteria.
Which are?
The scale and durability of its free cash flow, its ultimate capital efficiency relative to the rest of the portfolio, and its strategic fit within the long-term vision.
And Devon is now overwhelmingly a Permian-centric operator.
Yes, heavily concentrated in the Delaware Basin.
The underlying implication of Gaspar's framework is that if a legacy asset located in, say, the Williston Basin or the Powder River Basin or the Anadarko cannot effectively compete for capital against the returns generated by that premier Delaware Basin rock, it fundamentally does not belong in the portfolio anymore.
Right. It is mathematically more accretive to sell that Tier 2 asset to an operator who specializes in that specific basin.
And Gaspar provided a definitive timeline for the conclusion of this process, stating that the strategic review will be measured in months, not years, with a comprehensive update promised to the market this fall.
Which brings us to the ultimate conclusion of this Talk Tickers deep dive.
Let's bring it all together. We have analyzed the production beats, the unit cost reductions, the proprietary AI mechanics, the federal lease dynamics, and the balance sheet trajectory. Now, we must synthesize this data into an actionable bottom line for you, the listener.
The analytical verdict on Devon Energy's Q2 earnings call is straightforward. This was an unequivocally strong quarter, characterized by Basically, flawless operational execution.
Right. The integration of the Cotera merger is proceeding significantly faster than historical industry benchmarks.
And the deployment of autonomous closed-loop AI and advanced surfactant chemistry is yielding quantifiable compounding efficiencies in the field today.
Therefore, if you are a retail investor currently holding Devon stock or evaluating an entry position, the fundamental data strongly supports a hold or consider buying thesis.
You really have to address the behavioral reality of the current market here. The stock has faced downward pressure recently, not because the underlying business is failing, but because institutional algorithms and short-term traders are just impatient.
They want immediate clarity on exactly which assets are being sold and for exactly how many billions of dollars, and they are heavily discounting the stock until they get that press release.
But the most powerful signal an investor can receive is an executive team acting on a valuation disconnect.
Clay Gaspar stated on the call that he views Devon's current share price as severely undervalued relative to the cash flow the business is generating.
And that wasn't just standard executive rhetoric. He backed it up with capital allocation.
Because they achieved their long-term debt reduction targets months ahead of schedule, management explicitly stated they will differentially direct their discretionary cash flow into accelerating the share buyback program for the remainder of the year.
The management team is actively buying the dip on their own equity.
This creates a distinct window of opportunity for you. The market's impatience with the timeline of the portfolio review is allowing you to buy into a highly optimized, AI-driven, cash-flowing operator with a pristine balance sheet at a compressed multiple, right alongside the executives who know the internal numbers best.
You are acquiring a fundamentally superior machine while the broader market is just distracted by the noise.
Which leaves me with a final, highly provocative structural puzzle for you to consider as we wrap up. We know the strategic portfolio review concludes this fall.
Right.
Let us run a theoretical thought experiment based on the CFO's comments during the Q&A. Imagine a scenario where Devon announces the divestiture of a massive non-core asset package in the Williston or the Anadarko Basin for a multi-billion-dollar premium.
Which will be a pretty standard industry transaction of that scale.
Exactly. An analyst specifically asked the CFO, Shane Young, how the proceeds from a massive asset sale would be treated in the capital allocation framework. Would it just sit on the balance sheet, or would it be treated differently than standard operating cash flow?
Young outlined a very specific hierarchy for that. First, they would account for the frictional taxes associated with the sale. Second, they might utilize a portion of the proceeds to marginally accelerate their $9 billion absolute debt target.
But then he explicitly introduced a third option.
He stated that if the divestiture generates a highly material, large-scale cash proceed, an accelerated share repurchase program, an ASR would absolutely be on the table.
For those unfamiliar, an ASR is a mechanism where a company utilizes an investment bank to retire a massive, concentrated block of shares virtually overnight, rather than slowly buying them back on the open market over several quarters.
It's a huge shock to the float.
So here's the thought I want to leave you with. Imagine the mechanical impact on the stock price if management secures a $2 or $3 billion lump sum from a portfolio divestiture this fall. The debt is already fully managed. The dividend is fully funded.
Right.
If they take that multi-billion-dollar windfall and immediately execute an accelerated share repurchase program, while the stock is still trading at this depressed, impatient valuation,
the mathematical reduction in the outstanding share count would just be staggering. It would force a massive, immediate upward re-rating of the earnings per share and the free cash flow per share metrics.
It is a massive impending catalyst. The market is currently pricing in the uncertainty of the asset review, but it is completely failing to price in the mathematical leverage of what management will actually do with the cash once the review is finished.
When the market finally realizes the sheer volume of capital this operational engine is generating, you want to ensure you already own the machine.
The data dictates the opportunity. Thank you for joining us for this extensive Talk Tickers deep dive into Devon Energy's Q2 results. We will catch you next time.